The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
I'm fully aware that you can confuse conviction with craziness. I am adding to silver positions. I am adding to gold positions. And those do represent something of a cash position in my mind. I am aggressively adding to mining shares. There's probably more pain ahead, and I don't mind that. I mean, that's the race I'm willing to run, absolutely willing to run, because I know how the race finishes as well.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, I was thinking this weekend, whoever's sick of fixed markets, let's hear our listeners raise their hands. And even though we can't see, I'm going to tell you, their hands have to go up. But I was thinking this before, what happened in China Sunday night, which is just an overt dump of paper contract gold purposely to push the market down. I mean, nobody sells $2.7 billion worth of something when there's no volume if they're trying to make money.
The counter is, when you're wrong on a trade, you just blame the manipulators for taking it the direction you didn't think it was supposed to go. And that's where you just have to look at the numbers. You have to look at the numbers and realize that actually it's no longer the tinfoil hat community that would say there are people who are manipulating prices.
Do you remember when it was called conspiracy theory? Back in the old days, people would say, you're just a conspiracy theorist. Now people are going to trial for manipulating markets. They get a hand slap.
Exactly. So you've got the U.S. fixed income market, which is being manipulated. Prices are being fixed. You've got the European fixed income market, both government bonds and a few corporates, which are being manipulated and prices are being fixed. You've got Japanese government bonds. You've got Japanese corporate bonds. You've got Japanese equities. We've had the LIBOR scandal. We've had both commodities and currency trading manipulation scandals. And again, all of these have taken the notion of market manipulation out of the shadowy world of conspiracy theory into the light of common market practice. Now, that's not to say it's moral, but it still happens.
And nobody gets anything but a hand slap, Dave. It's a little bit like, if I can make several $1 billion on a trade and have to pay a few $1 million fine, well, what's the big deal?
As long as the manipulations support the established narrative, you find that not much is done to prevent them from occurring again.
Yeah.
And so for any trader in the world, you can look at this. The market move in gold on Sunday night in the Shanghai and on the New York Globex markets, the stunt was obvious and it was a blatant manipulation. It's a total of 57 tons of gold in the form of futures contracts, not physical metals, but paper contracts only, dumped onto the market in a 2-minute period.
2 minutes.
And it happened to be at a point of lowest possible liquidity. So think about this. When someone wants to get out of a position that they own, a large position, in this case $2.7 billion, it's best to work out of it slowly so as to get the best price and not cause the bid to collapse.
And you're going to do it during a time of volume. I mean, you're going to come in high volume if you're trying to get quietly out of a large position.
Always best to sell on an up day. If you're selling on a down day, you're just helping sort of drive the price lower. No, you're not going to get the best price. So When you move to the least liquid time frame where there are no buyers to accommodate what you want to sell, and then you bring $2.7 billion of product. And again, I use that word loosely because recall, there was not a single physical ounce of gold moved, but nevertheless, $2.7 billion worth of futures contracts. When you bring that to the market, the intent is, to me, obvious, to break down the psychology of the market, moving the price through a critical technical level of support. I think it's reasonable to ask who. I think it's reasonable to ask why. And I think we'll eventually figure it out. I think the easiest answer, if you're sussing out the intent, is to point to central banks who are in an all-out war to preserve the financial system, the banking system as we know it, and maintain the perception that all is well. I've used this analogy before when discussing the signal that gold sends in the context of the financial markets. Think of what the barometer tells you about the change in weather or even an impending storm. It tells you what is changing, and it might even suggest battening down the hatches. But if you can intentionally break the messaging that you get from the barometer, you can pretend that no storm is coming.
You know, this brings back memories. When I was a kid, in fact, one of the things that I wanted to inherit when my grandfather passed away was a barometer that sat in the panhandle of Texas. That's where their home was. It sat up on the counter. And the panhandle of Texas is Tornado Alley. I mean, everyone knows it. You know, we were down in the storm cellar some summers, a couple of times a week, you know, as storms passed. But I remember how important that barometer was to him. He would walk up and he'd tap it 3 times with his finger. And he'd look at that barometer. And a lot of times he did it with the kind of intent that was someone trying to protect his family from an impending problem. Right now, all the barometers, Dave, it's not just the barometer of gold, but all the barometers not only are broken, but they're being manipulated. A broken barometer just sits there, but a manipulated barometer can actually kill you.
And I think one of the things that's accomplished in changing the messaging that gold typically sends is elimination of culpability. And this is what I mean specifically. You can pretend that when the storm hits, no one could have actually known it. Mm-hmm. And the crisis that ensues, yes, it deserves extreme measures to solve it. And yes, we, the central bank community, are here to solve these problems. And goodness gracious, we could never have seen this coming. Well, part of the reason they won't have seen it coming, and they can claim so, is that gold is not trumpeting from every rooftop that something is not quite right. Gold throws central bank maneuvering into question. And certainly in terms of credibility, is one of those things that sort of says, hey, there's more and more people coming to the conclusion that you should not have your faith and confidence in the central banks. And again, if you can break that down where your only alternative is faith and confidence, call it the fallacy of false alternative, the central banks win.
Well, and let's remember what Paul Volcker, he's seen as the great hero central banker, but he actually expressed in his memoirs just how much control the central bankers have, and he actually regretted not pushing the price of gold down.
Yeah, that's right. In 1973, he said his one mistake in the 70s was not to take down the gold price. And frankly, why? Well, it shows too much of what was really going on. And central banks, quite frankly, are all about perception management.
Well, I know here at the office, we have been very busy actually selling physical gold. And in fact, the discussion between you and Drew has been, okay, what do we do when we start running thin? But I'm going to ask a question because the price does affect people who have, let's say, paper gold contracts or gold shares. How do you recognize the bottom of a market, whether it's manipulated or not?
If the only thing you're following is the price action of gold and you don't look at the details to see that it was actually a manipulated trade through a technical level, the consequence not only now, but 18 months ago and closer to 3 or 4 years ago, as gold was breaking sort of the 1540 level, it was psychological damage that was wrought.
Well, and again, Dave, we're talking about paper markets here. Not an ounce of gold actually was exchanged when you're talking about the 2.7 billion ounces dumped on the market on Sunday night.
And again, it's the issue of perception management because you're dealing with the psychology of the investment community.
You're trying to break a market. You're trying to break psychology.
Well,
you're trying to disappoint and discourage.
And this is what Volcker was getting at. His mistake in the 70s was not to break down a certain messaging that was occurring that was running counter to central bank policies and what they were trying to implement. So when you look at how you recognize a bottom in the market, what you're really looking for is the culmination of psychological reactions, which are the epitome of it can't get any more negative than this.
Right.
That's what they call a capitulation. And it is. It's a reaction to the decline, which is all emotion and not necessarily thoughtful. It can be knee-jerk. I can't believe it got through this level. What am I going to do? What should I do? Should I liquidate? I think I'm going to liquidate. I'm going to get out of everything.
I've heard this to a degree, not from our own clients, because our clients seem to buy for the right reasons, but I've heard this in the news media. Now, let me ask you, have we reached a capitulation point? I mean, has psychology been broken that much, or is it coming still?
You could argue that the physical metals market reached a capitulation last November. The current selling is far more of a futures game. Yeah. So you have derivative gold products and traders using those as sort of the tool of choice to access the precious metals markets. This paper trade is still dominating the market and current pricing. And I think that's why price volatility is what you're seeing. It's there. There's lots of price volatility, but the real metals are still in high demand. And I'm going to come back to the issue of capitulation in a minute. But first, just something that we see in the physical market. Doing this for 4 decades, we know something about the physical market.
Right.
We see plenty of buyers. There's no more sellers today than ordinary. In fact, because we broker precious metals, that's one of our businesses, and we do this every day, we buy and sell.
Right.
And to have half of our business as liquidations and half of our business as purchases is pretty normal. Right now, it's actually 60% purchases, 40% liquidations, which is disproportionately high. Ordinarily, it's more 50-50. And as we have engaged with people from all over the world, the phones are busy. No one's particularly worried. General interest is rising. And I think what we get from our clients is a sense that something is about to change.
Right.
And that price is not really what they're watching as sort of the defining factor, or certainly the motivating factor in their purchases.
Well, and I think there's one other thing, Dave, that has to be mentioned, and that is that all coins and products have a premium of some kind. There's a mint premium or there's a scarcity premium. If the U.S. Mint stops minting American Silver Eagles and there's still demand, all of a sudden you have a premium increase. But look at the $20 gold pieces right now. The premiums have actually been increasing, which means that the supplies are decreasing.
Right. In addition to that, and I mentioned this in this week's office meeting, for people who are today buying Silver Eagles, there's a 3 to 4 week delay on delivery. If you're buying silver rounds, probably a 2-week delay in delivery. Maple Leafs, a 2-week delay in delivery. The physical market is fairly tight. Premiums on junk bags of silver, the bid on a junk bag of silver, if you're liquidating it, is 10% over the silver price.
Whereas we've seen it actually right around spot, just a little above spot in the past.
What those premiums imply is that there is robust demand.
Yeah.
And so in the physical markets, there continues to be robust demand, even in the face of weakening prices brought to you by your futures price manipulation. So I think, again, where do we see our clients going? They're looking for what they're most comfortable with at this moment in time. There was an article in the Financial Times this week written by James Grant, and he's talking about how prices are all askew. Mm-hmm. And there's some confusion in terms of value. And I think this really gets to the heart of what our clients are reacting to, which is all is not well, although everything seems well.
Right.
And again, if you had to say, well, why does it seem well? Because perceptions are being manipulated, and this is actually what was intended. You're supposed to feel that all is well, even though instinctively, if you're a business owner, if you're a business manager, if you're an investor of assets, certainly, and I think investors are actually more clued into this than brokers and those on Wall Street, because you kind of know what works and what doesn't. Wall Street has sort of the permanent positive bias, and investors have sometimes the ability to say, yeah, but it's gone a little far. 5-6 years without a major correction, wouldn't it be reasonable to see something of a correction? And yet Morgan Stanley comes out this week and says, the next destination is the S&P 10% higher. And again, it's sort of when you get to the end of a pendulum swing, everyone projects prices that much higher.
Right.
Okay. I remember the Aden sisters were talking about gold being $3,000 back in 1980. When it was $850, and everyone's price projections get blown out at the end of a pendulum swing. Right now, price projections for gold are that it's going to 700, 500, 200, 0. I mean, the price projections keep on going down, 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 and that's what you typically see at the end of a pendulum swing. Remember, the same Wall Street firms, including Societe Generale, I asked their chief analyst when I was in China, I asked him in the Q&A, I said, were you projecting higher gold prices? Let's say circa 2010, 11, and 12.
Right.
And he said, well, of course. Of course I was. And I'm thinking to myself, so you were projecting higher prices as we were reaching a peak. In other words, gold's $1,900 and you're calling for $3,000 gold, $2,500 gold, $2,100 gold. And yet now that gold is moving down, the only thing that you can see is prices going down initially, down further after that, and after that, even further, it's going lower. It doesn't make any sense because it's what analysts do. You have that in the stock market today. Stock market's high, it must be going higher. Gold is low, it must be going lower.
Something I appreciate, Dave, talking to clients who have a well-grounded thought process and a long-term view, and I want to talk more about the long-term view later in the program, but I haven't really sensed that price is their main motivation.
You mean the gold buyer today?
Not just the gold buyer. I'm talking about, they're gold buyers because they're clients of ours, but I'm talking about just the overall philosophy of saying, I'm not really watching price. What I'm doing is I'm taking the facts and I'm making a good decision based on facts, not on manipulated prices. Now, the question comes in almost every conversation. If you didn't have gold, let's talk about the other assets. What do you feel comfortable with? Do you like the dollar right now?
I like the dollar better than emerging market currencies.
Yeah.
I mean, on a relative basis, it's better than emerging market currencies.
But long term?
In the long term, you know the Fed's record. And you also know that they haven't sorted out the accumulation, not only of the $9 trillion of debt that we had before Obama came into power, but also the $9 trillion that we've added since he came into office. And so we have a lot ahead of us. And we don't know exactly how we're going to deal with it in a higher interest rate environment. So no, I'm not particularly interested in the U.S. dollar on a long-term basis. On a short-term basis, it's fine. Long-term, no. U.S. Treasuries, this is a disaster waiting to happen. The fixed income universe, the only reason you're not going to lose your head tomorrow is because central banks are intervening. As we started by saying, there is more market manipulation, and this is sort of what everyone does. It's not even illegal. Governments are doing it. So how could they prosecute it if they're the ones who are fomenting fixing prices in fixed income and corporate bonds and Japanese equities and commodities and currencies? The only thing protecting you is government intervention. And the question does linger. It should linger in your mind. How long can that last?
So that's the answer to my bond question. I was going to say bonds. Now let's go to stocks.
I read Andrew Smithers over the weekend, and he's asking the same question about CAPE, the cyclically adjusted price earnings ratio and the Q ratio. And he's still saying these are very, very expensive prices to be paying. So I missed a year's worth of growth. Do you realize what happens when you get set back 20 years in terms of price volatility to the downside? I'd rather miss a year's worth of growth than have to start over. And I think that's what we're coming up against. I think that within the next 12 to 18 months, you're going to have a number of people in the financial markets in a generic stock and bond portfolio who financially have to start over. So do I like cash? As Smithers would say, I would rather take my 5 to 10% inflation hit than my 40 to 60% capital loss, which is in his mind a guarantee statistically at this point if you're just in a general equities portfolio. So where else would I rather be? Back to your question. There are small niches. Private equity is one of them. And I'm actually part of a private equity company in Kansas City that looks at small, privately held businesses.
Sort of outside the purview of manipulation.
Well, anything less than $20 million in market value is off the radar screen. Keep that in mind. If you want to stay off the radar screen, stay under 20 million. You're probably under the radar at 100 million. Because Wall Street's only interested in doing billion-dollar deals and doing $500 million deals, because the same due diligence goes into $1 million deal as goes into a $500 million deal. It should, if you're a careful investor. And so if you're looking at the total return, why not just do billion-dollar deals and neglect everything else? I think it's a fascinating space to be in because there are enterprises that have been well run for 20, 30 years, for 5 and 10 years, that need capital partners in order to grow and can't access Wall Street dollars. So there are niches, but I will tell you this. They are few and far between.
They have to be carefully looked at because that would be venture capital in a way, wouldn't it?
Except that we're not at the front end of most of those enterprises. Dealing with existing businesses puts us in a slightly different position in terms of a risk profile. Okay. Venture capital is sort of starting with nothing, hoping that it becomes something.
This is something that actually exists that now needs just a little bit more fuel.
Exactly, to gain momentum.
Well, you've got me intrigued on this capitulation thing because, again, people in their mind, they saw gold go down. And it's intriguing to hear the word capitulation being in November for the physical metals when actually people are calling right now going, when's the gold price going to stop falling? So explain capitulation. Why do you see the capitulation already occurring in the physical markets?
What is capitulation? It's when the vast majority of investors can no longer take the pain.
Right.
They can no longer take the pain. And they're basically saying, can I extract some value, any value? I'm not going to put this in it as a limit order. Give me anything. I just want to make sure I've got 2 cents versus 0 before this asset hits 0. And curiously, the physical metals market, as we mentioned earlier, it's seeing premiums in a variety of silver products, no real sellers of gold. The weakness still shows up in the futures market where the shorts are bold. And if you're looking at the futures market, those guys on the long side, they're kind of old and growing cold. No one is there to buy you have more sellers than buyers, so the price is being pressed lower. That's actually not a place where I'm expecting to see capitulation, because most of the activity is opportunistic short selling, and ultimately those short sellers have to cover their position. So it's going to create the equivalent of a synthetic purchase in order to cover their short position. So where you do see capitulation is in the mining shares, where people have owned, let's call it a non-expiring call option on the price of gold, something that has major leverage to a move in the price of gold. And of course, leverage moves both ways. Price of metals drops, what happens to the theoretical margins of those companies? They simply disappear. So capitulation is happening as we speak there. As I mentioned, it's already occurred, I think, November of last year in the physical metals market. But the shares of the mining companies are nearly there now. We'll talk about the average gold shareholder in a minute.
Well, when you see manipulation in the market, Dave, you almost always see the news services come out and they try to give a reason for what just occurred. It's not just a manipulation, not just crashing the market purposely. And the Chinese came out and gave a very respectable figure as to how much gold they've accumulated since the last time they've reported. And I think we need to talk about that because, one, it's probably completely fictitious. It seems to be the perfect amount of makeup on the girl. Not too much, not too little. It's just enough to be accepted into the international community.
Well, right. And I think that is the purpose of the 1658 number. You went up from 1,054 tons to 1,658 tons. Bloomberg's most conservative estimate was 3,500 tons, and many in the financial community had assumed that they would announce a 6, 8, or 10,000 ton number. They have been accumulating. You look at their import-export numbers. You look at their production numbers. They're the largest producer of gold in the world at over 400 tons per year.
Yeah.
And from 2009 to the present, you're looking at well over 2,000 tons just created on their own home turf, let alone what's been imported.
And they don't sell any. They buy it.
But here's the issue. You're talking about a political maneuver.
Right.
They want to join the SDR system. Less than 2% of global trade is done in yuan or renminbi terms, and they'd like to increase their market share, so to say. They'd like to increase the traffic through their currency.
Right.
They know that to be involved in the international economy in a more robust manner is to have their currency floating in a more universally accepted manner. And so what does that entail? Well, for them, it has included getting the IMF approval, the International Monetary Fund approval, to be in the SDR system, the special drawing rights system, which is a basket of currencies. And if you think about it, they're going to the Europeans, because the Europeans are the head of the IMF, and saying, listen, we would like to be in this club, and we think that we are stable enough.
Right.
Please ignore our stock market the last few weeks. Please ignore that. We've got it completely under control. But we do have enough gold to legitimize ourselves. We've got a lot more than Britain. We've got a lot more than a lot of other countries.
And a little more than Russia.
But not as much as you guys in Europe, not as much as you guys in the U.S.
We're no threat to you.
We're no threat to you. The 1658 number is a we're no threat number. It's enough to be legitimate, but it's not too much to make you uncomfortable.
I'm going to tell you, Dave, there is a softball team here at the company. I'm not part of it, but the guys who play, they hate sandbaggers. And there's a team that they play that showed up a little bit like the Chinese did, where they're like, oh, we're not very good. We need to be in this league. This is the league where we'll probably be able to win a game or two, maybe. And of course, they came in and sweep that particular bracket. Why? Because these guys are 22 years old and they're absolutely super fit and they play softball all the time. But they decided to sandbag. This is sandbagging, Dave, because we can count the ounces. I'm going to tell you right now, in 2013, when they crashed this market with paper, 700 tons of gold came out of one of the ETFs.
Right.
All 700 went to China.
Right. In a single day purchase, you don't find that quantity being bought by individuals. Because, quite frankly, the decision-making capacity of the mass, it takes a little bit longer than that. Do I want to own it? What's just happened? The price of gold is following. I think I do want to own it. How am I going to buy it? Am I going to buy a bangle? Am I going to buy a coin? Am I going to buy a bar? The man on the street doesn't make an instantaneous decision. A central bank does. And you're right. ETF gold that was liquidated in that period It went to China.
Yeah.
It was melted down 400-ounce bars and was converted to kilo bars and went to China. And no, it did not go into individual hands. Just some of it, I'm sure, did eventually.
Right. Let's talk about the kilo bar real quick. I know this is a side note, but why in the world would China have kilo bars if they thought that the central banking community was in control? Central banks trade 400-ounce bars, not kilos.
Well, and that's, I think, redefining sort of the role of the central bank in China and the future of gold in the world financial system. To basically look ahead and say, we understand that the 400-ounce bar is an anachronism. It's no longer relevant because we're going to need to trade in a smaller format.
Which is 32 ounces.
The question is, why would you need to trade in a smaller format? And I think the answer is implied. With gold trading at higher prices, a kilo bar is what will be a normal size transaction amongst central banks. The 400-ounce bar, I think, will remain an anachronism. And I think it also suggests the role that gold plays as a crossover asset between the central bank community and the general public. Because remember, it was 2009 that individuals eclipsed, for the first time in years, decades, individuals eclipsed central bank holdings of gold. So, I mean, really the balance of power was shifting towards the people, away from a controlled environment, if you will. And I think the Chinese are very savvy to position themselves at the center of the people, the people's demand for gold, and the role of gold within the central bank community. I think they're positioning themselves very well. Kilo bars are a part of that story.
I would love to see how much physical gold actually got transferred to China after this drop on Sunday night. Now, the market shut down for 30 seconds twice. Now, is that just another glitch like the New York Stock Exchange a week and a half ago? Is that another glitch? Why did they shut the market down for 30 seconds twice while the gold was plummeting?
It's an exceptional amount of volume in a very short period of time. And They do have natural circuit breakers in place. It is an exceptional amount. I think that goes to the point. You can find these points on the chart because they're frozen in time. Mm-hmm. You've got 30 seconds twice, which freezes it and says, okay, what's going on here? This is not normal trading activity. We've pre-programmed a shutdown of the market if too much comes at once because we don't know what the heck's going on. That's my point. This is not a normal liquidation. This was intended to damage psychology. And lo and behold, guess who ran with it? In the next 48 hours, I have read over 30 articles talking about gold going lower, a collapse in the price of gold.
It's going to go the way of the pet rock. Zweig said it's going to go the way of the pet rock.
Well, it is nothing more than a pet rock.
Yeah.
And so if you like pet rocks, then you would also have a lot in common with the average gold holder. That was Zweig's comments in the Wall Street Journal. But note that he's publishing, in the context of 30 other articles, all negative on gold. If you read the guys like Hochberg and Prechter and those who fancy the ideas of socionomics, where there are social indicators that tell you you're at a turn in the marketplace, 30 negative articles in 48 hours on the gold price, implying that not only has it collapsed, but it's going to collapse further, gives you a pretty good indication that the pendulum has swung about as far as it's going to.
Mm-hmm. All right, I'm going to shift over here because we're not just talking physical gold. Gold shares are affected every single time we see something like this,
and it's a different set of players. It really is a different set of players. The investor in a gold company is seeking a return in excess of a move in gold, understanding the possibility of big increases in the margins of those businesses. That is the money made in excess of the cost to produce or mine the metals. So with a rise in the price of the commodity, these companies do incredibly well. And it also works in reverse with a collapse in margins occurring as the commodity price moves lower. So this is something that Wall Street can wrap their mind around. Miners are either cyclically loved or cyclically hated because you can discount your cash flows. You can do your typical modeling on a company. And today, you know what? Wall Street hates them.
They have no time for them.
And I think it actually offers great insight into the Wall Street expectation for gold as the miners are selling more cheaply now and after the last 30 days relative to gold than at any time in recorded history. Okay, so you've had an exaggeration in the sell-off in shares, but really the only participants in that space are the Wall Street types who are looking at the expansion in margins and, again, sort of their typical textbook modeling for a company. Always watch for market extremes. They are telling you a lot within a little. Gold, the physical metals, they really don't understand, and they prefer to mock it.
Sure.
Because, again, you can't apply a discounted cash flow model to it. I mean, 5 times this morning, whether it's CNBC, Bloomberg, either the television or the radio or in newsprint, I heard someone say, yeah, but gold doesn't pay a dividend. Do you know how many times I've heard that? It's the classic, doesn't pay a dividend, it's not this, it's not that. Gold stocks, they do understand and are rightfully shunning if their long-term expectations prove correct. Lower gold prices, if that turns out to be accurate, lower gold prices this year, the next year, the year after that, the year after that. Guess what? The trajectory of gold stocks is also going lower if they're right.
Well, yeah, but let me throw this out. Wall Street usually is late to the party on gold shares, which is what they do understand. And I think the main reason, Dave, is because they don't understand gold. Since they don't understand gold, they seem to come into the gold share party right at the end. And that's why people hate gold shares a lot of times. People who don't understand gold, whose broker finally puts gold shares in when gold's 1900, let's say. Okay. At that point, that's the wrong time to come in.
Sure, exactly. So you see an expansion of margins for a lot of these companies from the 2002 to 2012 period. And some of their share prices went from $1, $2 to $20, $30, $40. And if you own them at $30 or $40 and they're backed to, you're not real happy with it. Not real happy at all. This is, I think, very important. Because the street lacks an understanding of gold, I think it's led them to an errant conclusion on the trajectory of gold stocks. And I think you're looking over the next 90 days at a window where that asset class in particular, if carefully acquired, will multiply wealth considerably over the next several years. Instantaneously? No. Are there going to be a number of companies that fail? Absolutely.
This is where carefully comes in.
Well, sure. And the over-indebted ones, they don't stand a chance at survival. But if you look at the Barron's Gold Mine Index, it is presently 21% below the low it has held since 1942. These are records, folks. These are records. And again, always watch for a market at its extremes. They're telling you a lot and a little. Actions that will help you in the long run usually run contrary to the feelings that are most easy to feel in that moment. Records on the high side, if prices are high, what do you feel? Greed. If records are being marked on the low side, what feelings does that evoke? Fear. My suggestion is that you should always operate in the opposite. If you're feeling greedy, act scared. If you're feeling fearful, act greedy. Does that make sense?
Well, another factor that was used for the drop in gold was just the strength of the U.S. dollar. We've talked in past programs about how we here in the United States a lot of times are viewing things almost like being in a room with no windows. Okay, we say, well, this is happening because we're basing everything based on the dollar. Other currencies don't necessarily tell the same story, but the dollar strength, it's affecting not just gold, it's affecting platinum, palladium, copper, iron. You know, we talked about the drop in commodities.
And I think there's a nuanced approach to the commodities. I mean, because one, each of the commodities does have its own supply and demand dynamics. And so you do have individual stories like iron ore and copper where production continues to increase. And it doesn't matter what's happening on the demand side. Supply is on the rise. You've got other stories, you know, you need to go through corn, copper, sugar, wheat, oil, platinum, palladium, silver, and a lot of them to figure out what are the unique elements. But I think when you look at the rise in the value of the dollar, it is pressuring commodity currencies greatly. So you have the loonies, that is the Canadian dollar, the Australian dollar, the real in Brazil, the South African rand, the ruble in Russia, and all of these currencies, and there's a few more, vis-a-vis the dollar, they're moving down towards double-digit losses this year, which incidentally advertises gold very well in those regions of the world.
Sure, gold's going up in those currencies.
At least it's holding its own. It doesn't look bad at all. We see gold at new lows in U.S. dollar terms, but to the Europeans, the Japanese, and for many of the countries we just listed, many of them see a fairly stable gold price for 2015. It's wise to remember that someone else may see things differently than you simply by standing and observing from a different vantage point. And I know that's small consolation to the gold holder here in the U.S. who references things in U.S. dollar terms, but do recall that panic selling is an event that occurs when someone believes there is reason to panic, and the rest of the world doesn't have a reason to panic out of gold. In their own currencies, overseas investors might just as well panic into gold.
Well, let me ask a question then, because, the talk for years now has been about when are we going to raise interest rates? You raise interest rates, you strengthen the dollar, you weaken those currencies even further. So when does the Fed raise rates?
So then we come around to that issue. And yes, it's on the horizon. Is it September? Is it December? Is it 2016? And I think much too much is predicated on the rise in rates. An actual rate increase, which is different than a suggested rate increase, which is all we've had so far, that is going to continue to put downward pressure on the exchange rates from currencies as far-flung as Indonesia and Russia, Brazil and Canada. And, I guess the one positive element there is that for their tradable goods sectors, it will improve their trade. So if you're an international exporter in any one of those countries, a cheaper currency improves your competitiveness. But it's very disruptive to financial markets. It's very disruptive to financial markets. So again, if we go from a suggested rate increase to an actual rate increase, I think you're looking at carnage in the emerging markets.
Well, doesn't money flow out of those countries, though? When the United States starts offering higher rates on their treasuries, money flows out.
That's what I'm talking about. The disruptive nature of an increase in U.S. interest rates and strengthening U.S. dollar is that it sucks hot money from the developing world back to the developed world. And as hot money exits, it creates disruption in those currencies. I mean, hot money exits are responsible for numerous financial crises over the last 3 decades. And so a significant rise in the dollar, should it occur, is a major trigger for cross-border capital flows. And it's a major equity, bond market, and currency disruptor.
Well, I think it's important to define what hot money is. When we look at bank reports, we do the bank ratings. We had a lot of calls after the program where we offered bank ratings. But one of the things when we do a bank rating is we look at the hot money index. And the hot money index is basically money that's not necessarily loyal to that bank. It's opportunistic. It's looking for the best return. And so there's a large block of money in the world right now that really will move at a whim if the interest rate and the safety tied to that interest rate improves.
The interesting thing is you can say, well, that's going to hurt them and it's not going to hurt us, except that we have an intertwined financial community. And so what happened in China the last few weeks has ramifications far greater than the subprime crisis here in the United States. For them, and certainly for us, and for the world financial system. To see an unwind in Thailand, well, we had that in the late 90s. To see an unwind in Vietnam or Indonesia or South Africa or Russia or Brazil, these are things that have cross-border implications and capital market implications. And I say again, we've seen a move in the dollar in anticipation of a tightening monetary cycle in the United States. Mm-hmm. If there's anything in the financial markets that has become consensus, it is that we're going to have this. Right now, it's only a suggestion. Right now, it's only a suggestion. They have yet to do anything. After 9 years, nothing remotely hawkish has been done. You can talk hawkish, but nothing has been implemented that is directly hawkish.
Let's say they do. Okay, let's say over the next couple of months that comes in. Maybe it's even a 1/4 of a point rise, but what happens there?
I think the world economy is in chaos. And again, the problem with the world economy being in chaos, even if we're faring better in the United States, it's still in an interconnected financial world, everything takes a downgrade. Everything takes a downgrade. So what if words are replaced by actions before 2016? The real disruptions to financial markets come after a series of hikes, not just a single hike, not the initial one, whenever that occurs, if that ever occurs. The initial one is likely to represent sort of a modest and tentative commitment. You know this. We talk about this all the time. The elephant in the room is the amount that our debts here in the United States have expanded since 2009. Try to consider the cost to raising rates when you've piled on an extra $9 trillion in domestic government debt.
You have to pay interest on that debt.
And about half that amount in corporate land. So 9, 4, add up a little extraneous stuff here and there. Let's say that we've added in every nook and cranny an extra $15 trillion in debt since 2009. A 1/4% increase in rates is the equivalent of $37.5 billion in new interest costs. And that's a modest increase in interest rates. But you're talking about just shy of $40 billion. A 1% interest rate increase is the equivalent of an extra $150 billion in interest payments. Interest payments. Okay.
Well, what if it's even more than that? Let's say it's 0.5%, 0.75%, even 1%.
Well, hey, I'm just talking about the new debt that's been acquired since 2009. I'm not talking about the old corporate debt. I'm not talking about the old government debt that predates. We're just talking about the extra expense that we have in the new era, where, again, we started with the debt problem. We still have debt in a monetary tightening cycle. I think the reality is this is an environment where the wheels begin to come off. The wheels begin to come off. So again, if a quarter of a point equals $37.5 billion, 1% is better part of $150 billion. And this is where you realize, yes, normalizing rates may be a good idea, but it's expensive if in the interim you've added a tremendous amount of debt to your balance sheet.
You know, Dave, as we talk about people looking at these prices in these markets, they just don't make sense. And really, it does make the most sense to continue to stay the course and run the race the way we should run the race. You know, I was reading in an Ironman or triathlon training document that said, absolutely run your own race. Don't let someone running past you faster change the pace that you've worked so hard to get to. Because what we're talking about is a long endurance race. Like, I'll give you an example. An Ironman starts with a long swim, longer than most of us ever do. And then it goes to a long bike ride, longer than most people do. And then it goes to a long run. Now, that's not 3 days. That's in 1 day. And so if you get your pace out of line because you're responding to the outside environment, you're not going to finish the race.
Well, yeah, and the reason you bring that up is I threw out a challenge here in the office to do a half Ironman next year.
In Kona, Hawaii, which is the granddaddy of them all.
Yeah, I said, I'm going to do this in June. If anyone's interested, just let me know. We'll all sign up and we'll all compete. It'll be a fun time. 20 people in our office are signed up to do the half Ironman.
I don't think you expected that.
No, I did not expect it. 20 people in our office are going to swim a mile, bike 56, run a half marathon. And you're right. Running your own race is very, very important. When you see a friend whose portfolio is growing leaps and bounds, run your own race. Run your own race. Because here's what happens. In 100 meters in the pool, let's say a fast swimmer can do it in 1 minute and 30 seconds. And it takes me 2 minutes and 30 seconds. Mm-hmm. I can say to myself, he's going to win and I'm going to lose. And yet I have no idea if he can sustain that pace for a mile or 2 miles. He may be wearing himself out and he may be in a very vulnerable position where he can't even finish the race because he's going at a pace that is ultimately unsustainable. Run your own race.
I remember when my son raced mountain bikes professionally, the guys at the start who just absolutely pumped straight up the hill. Now, mountain bike racing, the version that my son was riding was straight up, if you can imagine, ski hills, okay? These are virtually straight up ski hills and down and straight up again and straight down. These things would go 2 or 3 hours of riding up and down mountains. But the thing is, the guys who started the race the hardest usually were not the guys that you'd ever see on the second or third laps, or rarely ever at the finish.
I've done this before.
Yeah.
I did a sprint triathlon probably 20 years ago. And, it's race day. There's a lot of adrenaline and you want to win. And it's like being a novice trader. Hey, I just want to make money. Show me where I can make money. I want to make money right now. I'm going to win. I want to win. I want to win. I got into the pool and I swam 200 meters and I started to die. Lactic acid built up instantly.
That's a horrible feeling in water because you think you're going to drown.
Well, I had a lot more to swim, and that didn't even include the bike and the run after that. And lactic acid had already built. I was dead for the entire race because I wasn't running my own race. I was looking at everyone else. Everyone else was enthusiastic. We got in. And we got in over our heads. I was going way too fast. I was pressing the pace.
So the analogy we're going for here is to tell a person, make sure you look at the facts and stick with your long-term plan.
Well, exactly, because where you're at right now has no bearing whatsoever on how you finish this race. And I think the analogy is particularly apropos because, where gold is at, where silver is at, this is particularly painful. It's very painful. That doesn't mean the race is over. I think you should take the next step. I don't think you should quit. I think you should run your own race and stop comparing yourself to the performance of other people because in the end, you don't know how they're going to finish and you don't know if the pace that they're setting is at all sustainable. And I'll tell you this, in this current environment, the only thing that represents wind in their sails is the artificial juice they're getting from the Fed. Mm-hmm. That is not sustainable over a longer period of time. Market interventions that affect psychology in the short run, very effective, very powerful, but ultimately not sustainable. We need real growth to reemerge. We need entrepreneurship to reemerge, risk-taking to reemerge. We need a new capital cycle to begin, and we're a long way from that. We're at the end of a long-term experiment with leverage, a system that has never seen this kind of leverage built into it. And it ultimately, I don't believe, is sustainable. Now, look, a variety of indexes have already peaked. You've got progress dating back to, this is November of last year, March before that. The peak in those indexes, these are equity indexes, coincides with the rush to sell gold, where November marked the lowest trading level for gold till this week. Gold's at new lows. Those indexes are still failing to get to new highs. Do you see what I'm getting at? There's a bit of a disconnect. So we put in new highs back then, and those have not been surpassed. We have just surpassed the lows in gold. Specifically for those indexes, we're talking the small caps, we're talking the S&P, mid-cap 400, the Dow Jones Transportation Average. These are the indexes which are suggesting a non-confirmation for equities moving higher.
Well, an interesting example of that is look at silver. Okay, talk about gold manipulation. Somebody manipulated gold purposely, but silver, somebody forgot to manipulate silver.
I mean, it sold off in tandem, but nowhere to the degree that it tends to be the weaker sister of the two metals. Yeah. And yet you're right. It wasn't in the crosshairs in Shanghai and on the New York Globex markets. So actually silver in the precious metal space provides the same sort of non-confirmation for metals going lower as it's held above its previous lows. Thus far. Maybe it doesn't, but thus far it does. The NASDAQ, if you look at that, is the standout. It's the standout in terms of outperformance to the upside. It's sort of blowing a top. Led higher by Google. You look at any peak in the market, peaks are very lonely places. And we wonder if the NASDAQ's race isn't sort of petering out. Maybe it adds 50 points. How much more can you gain? I guess that remains to be seen. But we think that you're looking at a very rocky third quarter. And I expect to see a reversal in equity prices that is moving lower over the next 6 to 12 months, with gold breaking its downtrend, moving inversely to the stock market. So stocks moving lower, gold moving higher. What are the pundits saying?
Well, they're mocking gold and they're loving stocks.
Nothing but positive things to say about stocks, nothing but negative commentary on gold. This goes back to, again, pundits are cruel to the gold owner, and there's nothing but downside. And you usually see the gloves come off at these sort of market extremes. Financial commentators are trapped in what I think is sort of a typical psychological homogeneity. And that's common at every market extreme. Stocks are at highs. You're going to see everyone saying they're high and going higher. They said the same thing of gold in 2012. Your Bloomberg commentators, there was homogeneity in the view. Gold's high and going higher. You can't argue with an 18% rate of return. Annual returns for the last decade. They look like fools having not commented early on, so they join the bandwagon, and there's a homogeneity to the psychology. Negative for gold, positive for stocks. When there's homogeneity, be cautious, be careful, probably sell and go the opposite direction.
Well, and I think of two articles in particular. I think all the way back to my first year here, 1987. The stock market was hitting new highs. Everyone was saying that it's just going to the moon. And the price-earnings ratio was completely out of whack. And Fortune magazine came out with an article that said, this time it is different. Price-earnings ratios don't really make a difference anymore on stocks. Now, of course, it crashed in October of 1987. It was the worst crash that we had had since 1929. But now I think back to the 1999 article in the Wall Street Journal that just trashed gold. It said, basically, as long as we have Greenspan and the dollar and the Greenspan dollar, why would we ever need gold? Now, that article was written when gold was a little below $300 an ounce. And if you look at the chart, it's not long after that that gold had bottomed, the capitulation had occurred, and gold now is between 3 and 4 times that price.
You know, it's interesting. I think it's dangerously absent from the pundits' commentary today, along with their sort of gold slugfest. They're not willing to connect the dots in the larger commodities complex. You can look at the supply side dynamics in a number of commodity prices, but no one wants to look at a cold, hard reality. The commodities index, Bloomberg Commodity Index, is at a 13-year low. Okay, you don't get to these levels without being in a recession. Mm-hmm. So think about what the entire commodities complex is telling you, including Dr. Copper, oil, gold too. It's suggesting that we are already in a recession. Meanwhile, you have the stock market pretending like interest rates are getting ready to rise because we're not only out of a recession, but back into a recovery mode.
You can't raise interest rates in a recession.
No.
If you're a Federal Reserve chairman or on the board, you cannot raise rates in a recession. They know it's a recession, Dave.
This runs contrary to the recovery theme. So the way that the commodities index being at a 13-year low is massaged is very, very carefully, very, very carefully. But again, I think you're dealing with a community that's trapped at the far end of a psychological pendulum swing. And that's one of the reasons why they see recovery and only recovery. And gold is irrelevant and always irrelevant. Again, I would suggest whether it's Jason Zweig, he could even reread certain sections of his own book, Your Money in Your Brain. Great book, but I think he should review them. I'm fully aware that you can confuse conviction with craziness. I am adding to silver positions. I am adding to gold positions. And those do represent something of a cash position in my mind. I am aggressively adding to mining shares. There's probably more pain ahead. And I don't mind that. I mean, that's a race I'm willing to run, absolutely willing to run, because I know how the race finishes as well. When the markets turn, it's going to be easy in retrospect to see how sentiment was at an extreme and was irrational, irrationally negative in the gold and silver space, irrationally positive in the equity space. But you don't have that kind of definite, concrete knowledge until you're a little bit ways down the path and it's behind you. We still probably have more pain ahead. How much? I don't know and I don't care. We're very, very close to a bottom. No one knows the end of it till you're past it and are already moving higher, because we'll have to wait and see when exactly that is.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.